Hello and welcome. Today we're joined by Vinay Sharma, Senior Fund Manager at Nippon India Mutual Fund, where he manages three key equity strategies: the Nippon India Banking and Financial Services Fund, the Nippon India Focused Fund, and the Innovation Fund. With markets moving past early 2025 volatility and sector dynamics shifting rapidly, we'll explore his outlook on equities, his approach to stock selection, and his insights into some of the most active pockets in the financial space. Welcome, Vinay.
Thanks, Ruchira.
Good to have you here. Now, let's begin with some of the basics. Now that we're past the initial volatility of early 2025, how do you see the Indian equity market shaping up here on? Would you say we've crossed the worst phase of earnings downgrade?
So, Ruchira, that's a really tough one to answer at this point because there are so many moving parts, and a lot is dependent on how the second half for Indian economy actually pans out. So, if you look at domestic front, I think um, RBI government, I think all the constituents have realized that we have a little bit of growth issue. And large caps, if you look at the revenue growth in last maybe 2 3 quarters, large caps in India are probably growing at single digits in terms of revenue. And this is across sectors, whether you talk of domestic sectors, whether you talk of global sectors, that's what's been happening for some time now. I think RBI has realized. So on the domestic front, the good news is that we have now surplus liquidity across the board. RBI has cut interest rates very sharply. On the global front, there are still some issues remaining, such as the tariff. How will the tariff situation resolve? Will US go for a small slowdown because of the tariffs or not? Generally, global economy is a little bit of in a little bit of uncertainty, and I think that how that plays out over the second half makes a bearing on your question. But I were to believe if both RBI and government work in sync to revive growth, at least on the domestic sectors, the worst of earnings downgrade might be over. And in terms of how the markets look like, I think we are in a very stock specific, sector specific sort of market. And therefore, because there are so many moving parts, some of the things will pan out okay. If growth revives, maybe domestic sectors will start looking much better in the second half. But as of now, markets are not cheap. So I would say it's sort of a neutralish sort of environment where one has to be very stock specific, very sector specific, industry specific, things like that.
Vinay, now coming to your personal investment style, what's your strategy of investing in the stocks and how do you build the portfolios for the funds?
So, there are two parts to this answer. One is the usual, you look for sustainable growth, sustainable competitive advantage in companies and industries, and you look for management who are, striving to create value and are shareholder friendly and all of that. I think what is, what I have learned over my last 20 years and now what I try to incorporate in my stock selection and the way I build portfolios are two or three things. One, we try to avoid any sort of style bias. So finally, the way we look at stocks is purely based on value creation potential. If there is value creation potential over the medium term, it doesn't matter whether you classify it as growth stock, value stock, all of that. So we try to avoid those sort of style biases because finally we believe if you are investing in something today over the medium term, it has to create value and therefore it has to be a value stock in that sense. So that is one thing. The other is we try to analyze a lot of probabilities and scenario analysis when analysts pitch us ideas and when the team members come out with the ideas that they like. What I put on top of that is my filters of the world view or the economic view going ahead for the next 2 3 4 years. And then within those scenarios, what is the probability that you finally see of value creation? And whether there is that probability is in your favor, that risk reward is in your favor or not. So I think that is the second thing that we try to incorporate. Third, at various points of time, and it comes only maybe in a period of once in 2 3 years. But there are points of time when you have to believe that market is not always correct, and markets tend to overestimate or underestimate certain changes, certain fundamentals, and one has to be ready and willing to bet against them, against the market at those points of time. So that really becomes a big part of portfolio creation, specifically during those times, because that can generate, if you go right, that can generate superior alpha for your portfolio. So I think those are two or three big things that I've learned and tried to incorporate in my investing style over the past 5 7 years.
Right now, moving on to some fund-specific questions. Vinay, the Focused Fund, it had a challenging 2024, but it's been a strong performance so far this year. What's been driving that turnaround? Any particular sectors or stocks that have really made the difference?
So it's a mix of some top down going right and some bottom up stock selection working, which didn't really work last year. But I think one of the biggest contributors, if I recall correctly, is overweight financials as a position. We were very sort of sanguine on large private banks, and most of them have delivered decent returns so far year till date. Um, I think one of the primary reasons for that was, the differential between many other sectors and financials in terms of revenue growth has tapered down a lot over FY24 and FY25. As I said in one of my previous answers, that Indian large cap probably is growing at, single digit figures in terms of top line. And same is the credit growth for financial sector. So now that revenue growth differential, which was very obvious in FY23-24, is no longer there between financials and other sectors. So that has worked well. The other thing is there are pockets of consumer discretionary, especially on sort of upper middle class sort of consumption. Some categories there have done very well. Their revenue growth still is in mid-teens or more than 15-20% in some of those categories. And we were holding some of those stocks that have done very well in the past 6 9 months. And third, I think there were a few unloved sort of stocks or under-owned stocks that probably market was extrapolating their past few quarters of sluggish growth into long-term fundamentals, and we had an opposite view that maybe over the next 2 3 years, growth will look different in some of those sub-segments. And I think there has been a bottoming out of growth deceleration there. The growth acceleration has not happened, but because growth has now bottomed out or market has started believing that growth is bottoming out, some of those stocks have done well. So it's a combination of some sectors doing well plus some under-owned stocks doing well, all of that.
But now, when picking the stocks for the Nippon India Innovation Fund, how do you define and identify innovation? Do you look for specific themes like attributes to the R&D, focus, disruptive business models, or the market leadership?
So, Chirag, we have actually not gone into very stringent quantitative factors for defining innovation. We have, because innovation as a concept keeps changing based on the economic phase the country is in. Like, we can't compare ourselves to China and US. The kind of innovation that's happening there and the kind of innovation that's happening in India, there is a difference. There's no denying it. So how we define innovation is three or four basic parameters. One is, over the past 8 10 years, has the company evolved the business model itself? And have they been able to, get into new product segments, new business segments? Have they been amongst the top quartile in their respective industry in terms of new products, processes, all of that? So that is one. That is generalized across sectors, that we are looking for top quartile innovative companies across sectors. Then obviously there are some sectors which the entire sector is undergoing some technological shift, because of which every company involved has to change. So for example, if you look at auto today, we are moving from ICE to electric to hydrogen to hybrids and all of that. And every company has to to undergo that technological change if you are looking at 5 years, 10 years ahead. So therefore, auto, the entire sector becomes a potential candidate for getting into the innovation universe. Same is the case for, say, renewables, defense, some of the higher end IT services, all of that. These are sectors that constantly keep evolving, and therefore they are all part of innovation universe for us. So it's a mix of company specific factors and sector specific fundamentals, and those are the criteria that we have defined for our innovation universe.
Okay. Vinay, I just wanted to take it ahead. If suppose what kind of stocks in the innovation funds would you avoid in the flexi cap fund or the diversified equity funds, even though both can invest in across the market caps, and what makes them better fit for the innovation fund?
So there will be a lot of commonalities between a diversified equity fund and innovation fund, but I think the characteristics where of innovation fund universe are, some of these companies are at a stage where growth outlook for the next few years is probably higher than a Nifty 500 or the BSE 500 sort of universe, because these companies are either at a initial inflection point of technology, or they are sort of companies which were into private markets a few years back and have only come to public markets now, or are part of the new generation sectors such as food delivery or artificial intelligence or renewables and defense and all of that. So one typical characteristics of innovation fund and the universe, that the way we define it, is revenue growth potential for the next few years is probably higher than a BSE 500, NSE 500 sort of universe. And the other differential between an innovation fund and Flexi Cap fund is finally innovation fund, the way we are running it, we are not really looking at, index as a guiding principle. And we are not like trying to have the top 7, 8 large caps, which you will see generally in most of the flexi cap and multi cap portfolios across the industry. We are trying to make it a pure thematic fund, which where the revenue growth potential is higher, where the value creation potential is higher, where probably the technology risk is also higher compared to a flexi cap or a multi cap. So these are the characteristics that differentiate innovation fund stock selection versus a flexi cap stock selection.
Vinay, I'll just take it forward. When you're building a portfolio for the innovation fund compared to, as mentioned, like flexi cap fund or the multi cap fund, which are the key factors, for example, in terms of earning visibility, valuations, or the risk tolerance?
So, as I said, the first criteria is most of these stocks' revenue growth potential should be higher than a typical flexi cap or multi cap sort of universe, or let's say just BSE 500 or NSE 500, which is our universe of selecting companies in general. So the revenue potential is higher. There has to be some technological change or product change or process change. Something of that sort should have happened in the industry or company over the last 5, 6 years, or is supposed to happen in the future. That is the second differentiator. In terms of earnings visibility, probably some of these companies which fit into innovation universe might have more volatility, as well as some of them might be in initial stages of profitability. So profitability might not be established as of now, and we are looking at future in terms of how much profitability can be those specific sectors or industries can generate. So profitability might be a little more volatile. And similarly, in terms of risk tolerance, because there's a larger element of technology involved, maybe the risk profile of the fund is also slightly higher than a typical flexi cap multi cap fund.
Okay, now the BSE Finance and BSE Bank indices, they have been standout performance over the past year. What's been the key to their resilience?
So, as I alluded in one of my previous answers, one of the reasons is that a few quarters back, many sectors in India were growing at much faster clip than credit growth, and therefore BSE Finance was lagging behind in terms of the top line potential. I think that gap has now narrowed down sharply. And therefore that might be one of the reasons why those stocks have done quite well, or the sector has done quite well. The other reason, I think market is starting to believe, and that is what we also are now starting to consider in our investment thesis, is that maybe the worst of margin and growth deceleration would be behind us in financial sector in FY26. And when we go to FY27, if the second half of this year sees a growth revival in the economy, then maybe FY27 credit growth would be much higher, and also profitability of the entire sector would also look better because of the margin worries behind us. And as such, in we don't see a big credit quality issue in India at this point of time. Most of the asset classes have done well. Most of the industries and corporate segments are in pink health, and balance sheets are very strong. So FY27 might be a culmination of decent revenue growth, profitability inching up from FY26, and credit quality issues not being there. And I think in that anticipation is what financial sector stocks have done well.
Vinay, now in the recent report, CRISIL had stated that NBFC's credit growth could far outpace the bank in the coming years. What do you see as the main drivers behind this, and does this rapid growth come with the hidden risks?
I am not really in full agreement with that report, in the sense that over the past 2 years versus what the next 2 years would look, I think growth differential between banks and NBFCs would actually narrow down. That is one observation that I have. The other thing, NBFCs have grown at a faster clip compared to banks, is also because there are certain segments where NBFCs participate a lot more compared to banks. For example, if you look at gold loan, which as an industry is doing quite well because prices have gone up, and for the same tonnage of gold, you now can disburse a larger amount of credit. There, NBFCs are the main participants, and banks are a much smaller participant historically, although banks have increased their participation in the last 5, 6 years. But so there are some of these segments where NBFCs tend to do well. And that is, and similarly, housing as a category where banks have 15-20% of their loan books in that category, has been more stable than some of the other credit categories, and so therefore that also tends to help NBFCs. So there are these specific sector reasons that NBFCs have done slightly better than banks, and maybe will continue to do slightly better than banks over the next 2 years. But I think that gap will actually narrow down. That's my view on NBFCs versus banks in terms of growth.
Coming to the microfinance segment, it continues to struggle despite many indications that it will bottom out. So what is your opinion about this pocket, and do you think this struggle will continue in future too?
There are telltale signs that actually some of the stress is now starting to stabilize, other than a few pockets in South India, and a few regional nuances here and there. In general, we believe that over the next 6 months, you should see some stabilization in microfinance stress pools, and things will start to look much better, as I said, in FY27 over FY26 in many categories. I think even in microfinance, FY27 could turn out to be a much better year than FY26.
Vinay, now we are seeing that companies, raise fund through equity and bonds rather than relying on the banking sector. Given that the banks have been focusing on the retail and the corporate lending, do you think they should try to win the corporates or continue doubling down on the retail side of the business?
So, Srinath, from an economic point of view, it's a great thing if funding sources for our corporates are increasing, right? We have been trying to deepen our bond market. That has been the attempt of RBI for a fairly long period of time now. And I think some of those attempts are now are leading to some success of companies accessing bond markets more and more. So from an economic point of view, it's not such a bad thing that funding profile is getting diversified. From a banking point of view, I think bank managements have to move in cycles, right? There are times when you realize that the corporate loan market is overheated, or margins are getting squeezed, or we are getting into a risky territory in terms of credit stress developing or things like that. And same for personal loans. So I think banks have to work in where they see opportunities over the next 3, 4, 5 years in the medium term, where the profitability and competition is looking good and stuff like that. I would not say banks should double down on retail loan growth or try to win back corporate loan market. I think first, I have never worked in industry, and they all know much better than me, so I don't want to advise them. But I think in terms of penetration, retail in India has a lot of scope to go. There are many segments where penetration is much lower compared to many of our emerging market peers. And also, as economy becomes more and more growth happens in terms of per capita GDP, obviously there will be more sophisticated products in retail and retail loans and retail insurance and all of that. So I think that's a journey that banks will continue to have over the next 8, 10, 12 years. In between, the cycles of corporate loan happens, doesn't happen, depending on private capex or government capex and where our economy is going. So I think, as I said, this moves in cycles.
And now, speaking of retail lending, is this segment still as healthy as before, or do you see rising risks, especially with more exposure to personal loans and credit cards?
So just from a risk profile point of view, obviously, as the penetration of credit card and personal loans and all sort of unsecured lending, when the percentage of unsecured lending increases in your overall portfolio, obviously the risk profile also increases. However, that has to be compensated, in my opinion, in terms of increased return on risk-weighted assets or increase in return on assets from a bank's point of view. So, as long as you are able to balance that risk with enough rewards, I think there's no harm in growing personal loans and credit cards and also other sort of unsecured lending. Whether the stress has peaked out, we as a team believe there might be 1 or 2 more quarters of stress in some of these pockets. Also, because we don't know how the tariff situation will evolve and whether that leads to a new round of weakness in some of the SME, MSME segments. And some of these things are connected. When MSME, SME goes into some trouble, then their promoters also have liquidity issues, and therefore that comes into personal loan segments and all of that. So these are all interconnected in some one way or another. So if new issues crop out because of that tariff situation, that can also lead to 1 or 2 quarters of stress continuing. But overall, I think Indian household as a overall category is in a healthy shape, and most households have made decent returns, whether you are invested in real estate, gold, equities over the last 4, 5 years, and therefore household balance sheets are strong, and we do not see a systemic risk to retail assets at this point of time.
Vinay, now small finance banks have been struggling for almost 2 years now with no clear outlook. What is your opinion in this segment, and do you think they present a better opportunity than the universal bank, or has a risk reward declined in their priority to secure their loan book?
From a valuation point of view, some of these have become very interesting. There is no doubt because last 2, 3 years they have gone through. Some of them have their specific issues. Some of them went through stress because of stress in microfinance or general bottom of pyramid loan segments have not been doing well over the last few quarters, and then some of these were present in those segments. But as I said, some of these issues could just be cyclical in nature, and as we move ahead over the next 2, 3 years, their balance sheets might look much better than what they are looking today. And valuations are favorable. So from a risk reward point of view, yeah, we are starting to look at some of the small finance banks in a favorable with a favorable outlook.
Right, so just a couple of more questions. If you had to give retail investors a simple checklist for picking a good lending business, what would that include?
So if you are a retail investor, my first advice is just probably go through a index fund or a financial services fund, because lending as a business is very cyclical in nature, and you never know when the cycle turns, and these cycles could be 3-4 years in nature. Like, if you remember, 2015 to 19 was when India faced the corporate NPL crisis, and in those periods, most of the corporate banks did not give you any return. So I think understanding those cycles is quite important when you are investing in lending business. But if you want to invest in a lending business, I would say look at the last 5 to 10 years history. If the banks has managed, or banks or any financial institution that we are talking about, if they have managed cycles well and come out of most of the crisis unscathed, then those are the managements to bet on. That would be my first advice. My second advice is uh, look at pockets of underpenetration, where you can figure out that India has a long way to go, and we can have 8 to 10 years, 12 years of growth runway. Because growth itself can take care of many of the problems in this sector. And that would be the second piece. The third would be really cautious of excessive growth. In my experience in last 20 years as financial sector expert, excessive growth in this industry particularly leads to excessive problems a few years later. So if someone is growing far ahead of the system, and if things don't look in this sector, there is no smoke without fire. Most of the time, if there is smoke, there is a fire coming in a few years.
Vinay, now looking at the financial sector, where do you see the value right now? Are there any pockets you think are underrated, and do you feel are overrated but markets hasn't quite realized yet?
So in the financial sector specifically, I think there are many pockets which are decently priced at this point of time. Large private sector banks, despite the outperformance, continue to be below their historical averages, and they are sort of valued for the kind of growth we are seeing now. If growth inches up to mid-teens or 13 to 15% sort of range, then some of these banks will look undervalued in hindsight. So private sector, large private sector banks we like, large public sector banks also at this point of time look fairly reasonable. Most of them are trading at close to book value or less than book value, and growth and asset quality issues are sort of stable. Some of these are not even present in the high risk bottom of the pyramid segments or microfinance and all of that. So from a stability point of view, even PSU banks look okay. As I said, small finance banks, because of their particular issues, have become quite cheap. So they are fine in terms of risk reward. So I think there are many pockets in financial sector where risk reward from a 2-3 year perspective looks favorable, unless India goes into a credit crisis. If credit quality issues are stable, a lot of pockets have decent value in financials.
Okay, so talking about value, how do you see the sector overall with the re-rating we've seen in the recent years? Are PSU banks still attractive compared to the private banks?
I would not say compared to private banks, but I would say in silo they are decently attractive at this point of time. As I said in my previous answer, most of them are trading at below book value on a forward basis even now, or less than 8 to 10 PE if some people prefer PE. So from that point of view, risk reward looks attractive. I think the era of public sector banks losing market share steadily to private banks is also behind us. They are now able to grow as much as private sector banks in at least segments like corporate loans and housing loans and general auto loans and all of that. So they are going toe to toe with private sector banks. Their return ratios are fairly stable. I don't see any credit quality issues coming over the next 1 or 2 years. So I kind of like PSU banks at this point of time.
All right. Well, with that, we've come to the end of this conversation. Thank you, Vinay, for sharing your insights.
Thank you. Thanks for the opportunity.
Well, for more such conversations, in-depth fund analysis, and investing tools, head over to Value Research website and subscribe to our YouTube channel. Thank you for watching.